Well, good morning, Jaginder Rana here. Property reinsurance is the topic of our discussion today. Property reinsurance. So let us understand what is reinsurance. In fact, reinsurance is the insurance of risk assumed by insurer. In other words, it is an agreement or it is an arrangement whereby the insurer insures a part of risk again with the reinsurer in order to offload its liability. The term of the transfer are set out in a contract between the reinsurer who assumes the risk and the reinsured who cedes the risk. So reinsured pays a premium to the reinsurer proportionate to risk transfer as per terms mutually agreed by them. Then in return the reinsurer agrees to pay a portion of loss occurring under policies issued by the reinsured. The reinsured gets a commission, that is RI commission, on the premium paid to meet out its management expenses and acquisition cost. There are certain terms which are frequently used in a reinsurance contract, like cedent or reinsured, means company who seeks reinsurance and pays part of premium. Reinsurer means a company who accepts the reinsurance premium and pays agreed proportion of loss under the treaty. Then retention means maximum amount of loss which a insurance company is willing to absorb. The cession, portion of risk transferred to reinsurer. Line, a line represents the retention by ceding company. Then PPW means premium payment warranty. RI commission is part of RI premium paid by reinsurer to reinsured as commission, also known as deduction. Then risk excess means risk excess of loss. Cat XL means catastrophe excess of loss. This is the classification of reinsurance. This image is showing that the reinsurance is divided into two portions, that is facultative and TT. TT again divided in proportional and non-proportional. Under proportional TTs you will find quota share, surplus, facultative, obligatory and pool arrangements. And in non-proportional, excess of loss and stop loss. This is the classification of reinsurance. The same are elaborated here in detail, like facultative means individual risks are submitted to reinsurer for a consideration. Coverage terms and conditions are negotiated. The reinsurer may reject the risk. This is on per risk basis. In proportional TT, quota share, surplus TT, facultative, obligatory TT, there are proportional TTs. In this, all risks are falling within the scope of the agreement, must be ceded and must be accepted. So coverage is automatic. But in non-proportional, that is excess of loss and stop loss, these are non-proportional TTs where reinsured retains a certain agreed amount and each and every loss called retention. So which is also known as attachment point, and the reinsurer pays balance loss amount over and above the retention up to a maximum limit of liability agreed beforehand. As far as pool accounts are concerned, term pool and nuclear pool are already there. Facultative reinsurance stands for each risk is considered separated by reinsurer who has the option to either accept the full risk or a part of it or decline it in toto. Then the premium depends on the nature and quality of risk, loss history and net cat exposure at risk location. In the proportional reinsurance, A reinsurer accepts liability up to the agreed percentage share in each and every risk written by reinsured. There is the compulsory sharing of premium and loss between the ceding company and the reinsurer. Loss is according to a predetermined percentage of share. Cession is must for each risk under proportional treaty without selection. Examples are quota share, surplus, facultative, obligatory, and pools. So this quota share, you can see this image. Here example of 40% quota share treaty is given, retention is 60%. So another is surplus treaty. Surplus treaty allows the ceding company to reinsure under the treaty a part of the risk which is not retained in his own account. So here the ceding company decides retention on each and every risk within the terms and conditions of the treaty and cedes balance to the reinsurer. The capacity is defined in terms of line. A surplus treaty is arranged for multiple lines. So a line being the amount of ceding company's retention, and this retained portfolio becomes more homogeneous or balanced, it can result in adverse selection against the insurer. Let's understand the retention. What is retention? Because the amount of risk the ceding company keeps on its own account is called retention. This is decided based on company's financial strength and underwriting philosophy, keeping following thumb rules in mind. This is an example of policies under surplus treaty with fixed retention of 50 crores. Then comes the facultative obligatory treaty. This is also called as auto-fac treaties. It has the features of both fac cessions and obligatory treaties. Ceding company has the option to cede. As for facultative risk, and the insurer is bound to accept. Means no option to decline. As under a treaty arrangement, a share of the specified risk offered by ceding company. So fac obligatory treaty comes after a surplus treaty and gives automatic reinsurance facilities to the ceding company when surplus treaty has been exhausted. Then there are pool arrangements. These pools are made to create a capacity to handle risk of a catastrophe and nature where the severity, catastrophe nature where the severity of loss may be very high. So to create local capacities and reduce the flow of reinsurance business outside the country. In Indian market currently two pools are running, terrorism pool and nuclear pool. And this arrangement for premium underwritten by all insurers in a specified category of business goes a common fund called pool, and claims, if any, are paid to the respective company from the pool. All insurers willing to participate in pool are called members. They would have to agree for a specified percentage of participation share, which is to be decided at the beginning of the financial year. All pool members are offered their respective share of premium on debt to cession basis, and all pool claims are recovered from participating members in the same proportion. So GIC acts as pool manager and they charge from each member some agreed percentage in total ceded premium toward the administrative expenses. Profits, expenses and losses are shared in same proportion. Then comes the non-proportional treaties like excess of loss treaty and stop loss treaties. So the excess of loss TT means under these TTs, reinsurers pay only if the loss, that is not of all recoveries under proportional TTs, exceeds the agreed retention limit or attachment point. So this retention amount so agreed is also called deductibles under the TT. Then all payments under TT are however limited to upper limit agreed in advance, say 25 crores into 2 crores. So here the attachment point or deductible is 2 crores and the limit is 25 crores. That means reinsurer would pay if the cost or if the loss net of all recoveries exceeds rupees 2 crores and would be limited to maximum 25 crores. The TT premium is decided based on exposure growth of underlying TT layer, TT limit, deductible and portfolio analysis to ascertain the frequency and severity of such losses in the past which were beyond the attachment point. A type of excess of loss TT are risk excess loss TT. Means this TT is arranged for the protection of gross retention under the quota share or surplus TT. That means the insurer's retention in each loss under proportional TT can be further recovered to some extent under risk excess of loss TT. So this TT operates in excess of loss basis. That means the gross retention must exceed the agreed deductibles to get recovery from reinsurer under the TT. Then risk excess of loss TT. There the event limit are also decided. And then comes catastrophic excess of loss TT. So CAT excess of loss cover is designed to protect the reinsured against the aggregate accumulated net retained loss from an event over and above the deductible, but up to a maximum limit as per agreed beforehand. So it is also called per occurrence excess of loss cover. This TT will trigger only when the sum of individual net retained loss under proportional TT exceeds the CAT excess of loss deductibles, which is normally higher than risk excess loss deductibles. Examples you can see. Then comes reinsurance layering. So reinsurance programs are also sometimes designed to layers. For example, if a insurer wishes to cover a total exposure of 150 crores in excess of 5 crores, then it can be arranged in various layers based on the experience rating and exposure. So see an example like first layer with reinsurer A, 15 crores into 5 crores, no reinstatement. This is a primary layer. Second layer with reinsurer B, 40 crores into 20 crores, one reinstatement. Third layer with reinsurer C, 85 crores and into 60 crores, one reinstatement. This no reinstatement means that once the available limit in excess of retention is adjusted, that is, the layer is burnt, no reinstatement would be possible and a insurer would have to arrange for new layer either with the same or with some other reinsurer at renegotiated price. One reinstatement means that once the layer is burnt, that is, once the full limit is adjusted, one restatement of one layer would be possible on payment of additional premium. So this is the layering. Layering can be done for both risk excess of loss as well as catastrophic excess of loss TT. Then types of CAT or excess of loss TT. Cat excess of loss means per occurrence basis. That is, this treaty covers multiple losses from a specific group of perils during a specific time period. The most common perils are windstorm, cyclone and hailstorm, sometimes associated with hurricane or tornado, etc. So time period have to be defined specifically in treaty, and normally it ranges from 3 to 14 days. Cat excess of loss means the works on aggregate loss basis as compared to per event deductibles. So in this treaty, if the aggregate event loss exceeds the defined aggregate limit, recovery is made under the treaty. Then comes stop loss treaty. In this treaty, the ceding company would recover once the loss ratio of portfolio, after adjusting all available recoveries from other treaties. For example, QS or surplus exceeds the agreed percentage loss ratio. QS means quota share. Loss ratio limit, that is attachment point. This is also called loss ratio or aggregate treaty. Or reinsurance coverage is written on an annual basis. So there could be few forms of reinsurance treaty like run-off treaty. This means that the liability of the reinsurer under policies which became effective under the treaty prior to the cancellation date of such treaty shall continue until the expiration of each policy. Another is cut-off or clean-cut treaty. This means that the liability of the reinsurer under policies which became effective under the treaty prior to the cancellation date of such treaty shall cease with respect to losses resulting from accidents taking place on and after said cancellation date. So there could be certain working examples which is showing the calculation, and then importance of PML in RI placement, because importance of loss limit or PML in reinsurance large risk is very important, very significant aspect. Currently, reinsurance of all mega policies is done based on overall policies loss limit taken by insured. So in absence of loss limit, the PML of risk is worked out by insurers risk engineer as per their internal underwriting guidelines for PML computation. In case the PML report is not available, standard method of PML calculation is used and is calculated as like PDPML or BIPML. PD means property damage or BI means business interruption. So total PML of the risk shall be property damage PML is plus BI PML. And then comes the retrocession. Retrocession means it means reinsuring a risk by reinsurer. In other words, it means that a reinsurance company seeking support from other reinsurer for full or part of their exposure. In case of reinsurer provides a 20% support to a reinsurer, it is reinsurance, and if they seek further support from the other reinsurer for part of business, say 10%, then it is known as retrocession. So retrocessionaire is the reinsurance company who provides RI support to ceding reinsurer. So if reinsurer A seeks further support from other reinsurer B, then B would be known as retrocessionaire. It is the overriding commission is there. That overriding commission is earned on the retrocession, that is the commission earned by a reinsurer from retrocessionaire. And there is another term called fronting. It means 100% transfer of risk and premium to a reinsurer with no retention by ceding reinsurer, or reinsurer that is fully ceded to reinsurer. So this is all about the reinsurance now. This is property of reinsurance. Thank you.